Hello everyone, a very good morning, afternoon or evening. Thanks so much for taking the time out of your day to be with us. So just quickly, am I coming across loud and clear, and can we all see the welcome slide? If you can just type yes in the chat box, that would be fantastic. Brilliant, thank you. Okay, excellent. So in this webinar, the plan is to go over an introduction to technical analysis, which is ultimately designed for those traders just dipping their toes into the world of charts and technical analysis. Every single trader at one point in time was brand new to all technical concepts, where everything seemed overwhelming. I'm sure most of us have seen there's an absolute truckload of technical material on the net. I mean, if you just Google technical analysis, at the time of creating this presentation, I noted an eye-popping 1.85 billion results were generated in half a second. So with so much information available, it's important to keep your study structured and focused on what is significant, and then be able to apply your newfound knowledge to become more informed and ultimately more profitable traders or investors. So as a heads up, I'm going to assume most of us here know their way around the chart. If not, feel free to watch previous webinars on Forex Basics or the presentations recently given by my colleagues on MT4 and MT5, which can be found on FP Markets website or FPM's YouTube channel. Guys, if it's okay, I'll refer to technical analysis as TA going forward. It just makes my life a little easier. So also for any of us interested in a recording of the presentation, please, you can find this either through the FPM website or on FPM's YouTube channel. Also, I believe our support team send out an email after the webinar ends with instructions regarding a recording. Okay, as always, before we kick things off, let me just run through, sorry about that. So this is the disclaimer. So it basically informs viewers that information presented in this presentation is intended for general advice only, and none of it should be relied upon as personal advice. FP Markets do not take into account your investment objectives, financial situation, or particular needs. So really then, what this means is what we discuss in this webinar should not be considered as investment advice. So moving quickly on, for those not present in the previous webinars, I'll just quickly run over who I am and briefly introduce topics of focus for this presentation. So my name's Aaron Hill, and I'm proudly a part of the research team here at FP Markets. I've been involved in the financial markets since about 2010, as underlined in previous webinars. I was also incredibly lucky to begin under the guidance of two consistently successful traders. In terms of qualifications, I completed TMT levels 1 and 2 and enrolled on level 3 this year. I also recently received the CFT qualification from the International Federation of Technical Analysts in 2020. And as for trading, for me personally, I like to keep things as simple as possible in my approach, adopting concepts such as price action, Fibonacci, the relative strength index or RSI, and most importantly, chart psychology. These are aspects we have plans to go over in future webinars, working from beginner to advanced. Guys, also please feel free to check out FPM's Trading Hub. Guys, it really is packed with educational content and daily analysis, using both fundamental and technical analysis. As for presentation topics, we're targeting 3 core subjects today. Someone's saying they can't see the video. I'm not sure. Guys, can you all see the slides? Just to check that everyone else can see them. Thank you. Okay, I'm not sure what the problem is then if you can't see the video. I'm sorry about that, because everyone else is seeing it. Okay, so yeah, these are the we're looking at 3 core subjects today. So a brief history of technical analysis, or TA. Here I'll introduce the concept of TA and briefly dive into some of its long and colourful history. We'll also take a look at the basic principle of TA, namely the trend. So what we'll be looking at is things like the definition of a trend, retracements, pullbacks, and all that good stuff. Finally, we'll take a look at some chart patterns and candlestick formations. As I'm sure you can we can all appreciate, going into these configurations in detail is really quite beyond the scope of this webinar. So what we'll do is look at a couple of popular variations and then go into detail later in immediate and advanced presentations. Also, ladies and gents, following this, we'll look at taking any questions if any arise. As usual, if I'm unable to get to all questions, please feel free to go ahead and send them to me and the research team. You can send any questions or requests for future webinars to marketanalyst@fpmarkets.com. Okay, so the concept of TA, it essentially involves using historical, price action, and volume data to forecast market movement. So this can include the basics such as trend studies, adopting technical tools like trend lines, support and resistance levels, or more commonly referred to as support and resistance zones. Although plotting support and resistance levels may seem, it can seem a simple task, it can be quite a detailed subject with, as I'm sure you've seen, many traders adopt different methods. So therefore, learning this can take many screen hours to attain a level of proficiency. What I mean by this is having the ability to plot levels you're actually confident in, that will highly likely bounce price. So, we as traders, we can also use technical indicators such as the relative strength index, or RSI, the moving average, convergence, divergence, or MACD, and we can also use moving averages as well to help analyze the FX market. So all of these are subjects we're going to move on to in the next couple of weeks. It's also worth noting that traders have access to volume indicators. Now, this may be a little advanced for newer traders, but please bear with me here. So for the retail forex market, that is OTC or over the counter, volume generally refers to the number of ticks. So in other words, the price changes that appeared in the time interval. So the volume indicators you see on MT4 tend to represent tick data, not actual volume data. So this, of course, is unlike the futures and options markets, which largely trade through exchanges, where volume is calculated by counting the number of contracts that have been bought and sold over a given time. So in capital markets, so common capital markets are the stock market and the bond market. So volume for the stock market, that is, it is counted as the total number of shares that are actually traded or bought and sold during the trading day. So bonds, I believe, and please correct me if I'm wrong, guys, if there are any bond traders here, they also largely trade OTC, and therefore accurate volume, I believe, can be a challenge. So with this in mind, where did TA begin? What's interesting, guys, is if you Google who invented TA, more than 50 billion results show. But for me, at least, the first result showed Charles Dow as the inventor behind TA. Although Dow occupies a large space in the TA realm, which I'll be touching on shortly, some aspects of TA, according to my research, began to appear in Amsterdam via, I'm not sure if I'm going to pronounce this guy's name correctly, but Joseph de la Vega's accounts of the Dutch financial markets in the 17th century. So in fact, I believe back in 2018, a book written by Joseph de la Vega in 1688 went on sale at Sotheby's Rare Books and Manuscripts online auction for an estimated, you won't believe this, for an estimated 200 to 300,000 US dollars. Unfortunately, I was unable to find out how much it eventually went for. But in the book, what's interesting are the 4 principles Vega sets out. And they're reasonably applicable to any new traders today. So let's just quickly run through these. And bear in mind, this was hundreds and hundreds of years ago. So on the off chance that you're wrong, never give anyone advice to buy and sell shares. I can only assume this means avoid giving investment advice, because I hope we're all aware, because individual trades are always random. There is absolutely no way of knowing if one single trade will be a winner or loser. It doesn't matter. It doesn't matter how much technical confluence you have or fundamental analysis you do. There is absolutely no way of knowing if one single trade will work or fail. So take every gain without showing remorse or about missed profits. So in other words, don't kick yourself for missing the absolute peak or trough. So don't try to catch the tops and bottoms. I think that's what that's generally trying to say there. Profits on the exchange are treasures of goblins. I believe this means a profit today could be a loss tomorrow. So finally, whoever wants to truly thrive as a trader has to have patience and money. I'm sure we can all relate to this statement, which is pretty much self-explanatory, and it's well documented by many traders. Patience and funds to trade with are crucial in the trading world. Without these two, you simply cannot function. Many also credit TA to Manisa Homer, and I do hope I at least came close to pronouncing his name correctly. The reason why Homer is credited as a pioneer of TA is he is said to have invented candlestick charting, which I'm sure we're all aware is considered a backbone to TA to this very day. Steve Neeson is responsible for bringing candlestick patterns to the Western world in his, I believe, 1991 book called Japanese Candlestick Charting Techniques. This is widely available on Amazon and throughout bookstores, and was one of the very first books I read. The history of TA in the US, however, as far as I'm aware, kicked off in the early 20th century. The most credited work, I believe, came from the writings of a reasonably good-looking chap, Charles Henry Dow. It's a theory that's been built on throughout recent decades and now forms the basis of modern technical analysis. However, Dow's writings were never formally put into text until Robert Ray wrote a book called The Dow Theory. Okay, onto an important part of any TA method, the trend. A lot of investment terms are thrown around these days, but trend is one of those terms that all traders must understand. So for those completely new to charting, a trend is what many traders and investors pursue to make profits in the markets. So without trends, unless you're an incredibly skilled range trader, but still the markets will always trend within the range, right? Depending on what time frame you're looking at, it's going to be difficult to make money. I'm sure most of us have heard of the old adage, the trend is your friend, and it's really true. If you manage to time the trend correctly and have the patience and risk management to ride out pullbacks and retracements, an upward trend or an uptrend, as you can see on the slide, occurs when price action clocks higher lows alongside higher highs. It's a relatively simple configuration, though do be aware it's seldom as uniform as my example here on live charts. The same can be said for a downward trend or downtrend formed by lower lows and lower highs. Again, guys, it will rarely look as uniform as this on live charts, but I hope you get the gist of what I'm trying to demonstrate here. which is essentially to look for clear swings, especially if you're a newer trader. However, to make this a little clearer, on the slide we have the pound-dollar daily chart and the dollar-CAD daily chart below. The pound-dollar chart has, as you can see, been in an uptrend since the unit touched lows around 14.09 in the first quarter of 2020, right in the midst of the COVID-19 pandemic. Note we have clear higher highs, high lows, high highs, high lows, higher highs, higher lows, and now the pound has just taken off with no really clear high highs or higher lows, unless you dive into the smaller swings here. I mean, it's obviously trader dependent as to how much detail you go into in terms of price swings, but for this demonstration, we're keeping things to the basics, showing only the clear swing points here and here. Now, if you look at the dollar CAD chart beneath, you'll note that we're in a clear downtrend, formed by way of higher lower lows and lower highs, lower lows, lower highs, lower lows, lower highs. Again, I must emphasize this, for newer traders, I would always stick to the clear swings. I would never try to dive into the smaller time frames at this point. Okay, so just to try and expand on this, you'll note a trend never follows a straight line. Price always ebbs and flows. No matter how much we'd like price to trade in one direction, it's always going to ebb and flow. So with this, you may have heard of the terms pullbacks and retracements. So the retracement is essentially a smaller counter trend movement within the larger trend. Retracements are always corrections or downward corrections to the principal trend, in other words, the larger trend. The length of the retracement can provide us as traders with crucial information as to the health of the trend. An uptrend with deep retracements, as in the one shown on the slide, suggests, for me anyway, buyers, although we're in an uptrend, do not really have a firm grip on things, and sellers, may be growing in confidence. So now, of course, like anything in TA, just because we're seeing deep retracements, it does not mean we'll see a change in trend to the downside. It's just a hint things to the upside may be slowing. I would need to see more evidence that sellers could make a stronger entrance, such as a long-term resistance level, for example. So on the other side of the coin, an uptrend with shallow retracements show buyers are effectively in the driving seat, not really allowing sellers to form any kind of grip. But again, there is never any guarantee buyers will continue to climb from here. It's just one part of the technical puzzle we can use to help make informed decisions. So as for downtrends, I won't go over that because it's simply the reverse of an uptrend, and the retracements are instead labeled as pullbacks. Okay, now we're on to candlestick patterns and chart patterns. As mentioned at the beginning, going into detail with these patterns is beyond the scope of this webinar, but I hope I can hand over enough material to get your feet wet, shall we say, and we'll look to build on this in future webinars. So chart patterns, are essentially formed by combining support and resistance levels and trend lines. In all cases, the pattern is, shall we say, finalized or completed once price breaks out and hits the TP objective, TP being the take profit objective. An important point to bear in mind is that patterns will never be exactly the mirror opposite from example to example, though each should have the characteristics or rules, should I say, that form the pattern's framework. So basically, that they will never look the same. Traditionally, we also divide patterns into continuation and reversal formats. Though it's worth being mindful that some patterns can be defined as both modes, depending on where on the price chart they form. They will become clearer once this will become clearer as we dive into more detail in the near future. Right, so on the slide we have two very common patterns called a bullish flag and a bullish pennant. They're the same for bearish variations, just simply flipped the other way. These patterns are commonly found in the forex market and on all time frames. So they're also considered continuation patterns and seldom recognized as reversal structure, as far as I've seen. Guys, can I just ask, do any of us trade these patterns? Have any of you had any experience with these patterns? If you could just throw yes or no in the chat box. Excuse me. Okay. Okay, thanks guys, excellent. So we've got a mixed bag there. So yeah, I mean, if you're just starting with patterns, I would wholly recommend these two patterns as a base, because not only do they form so regularly, and they're very high from what I've seen, and this is only my personal opinion. They're really high probability, especially in trending markets. And as I said, you can trade them on all time frames. You can, if you fancy the 1 minute time frame, which I wouldn't advise really, especially for newer traders. You can trade them from the 1 minute time frame, or you can trade them with confluence. So for instance, if you find if you find you've broken a daily time frame resistance, and on the M30 you're finding a bullish flag form, is fantastic. It can really produce some good results. Also, so for instance, if you break the daily resistance and on the break you're forming a bullish flag or a bullish pennant, these can really add weight to your trade and provide entry and stop levels to work with. Okay, thanks for that, guys. So back to the slide. So the flag, it's a short channel. It's formed by a short channel of price action that generally slopes opposite to the trend, formed by two parallel downtrend lines. The pennant is a short triangle formation that does the same, only it's formed by two converging trend lines. For me, I always want to see at least 2 points hold before determining whether the flag or pennant is valid. And I also want to see that the pattern is preceded by a reasonably sharp up move. I remember reading during my studies that the best ones are when the angle is at a 45-degree. So very similar to this drawing actually. So when the angle is at a 45-degree, slightly 45-degree slope. But also if it's a powerful move, apparently I read, and don't quote me on this, but a 90% success rate if the slope is exponentially higher, is stronger. They've got a really high success rate. So for the price target for these patterns, following a successful breakout here, is measured by taking the distance from the beginning of the sharp up move and simply adding this to the breakout point. So there's nothing else really technical about that. What you can do, what I've done in the past, is you can also use Fibonacci studies. I won't go into too much detail here about that, as I don't want to confuse any newer traders, but you can also use the Fibonacci extensions and projections here to see if they converge with this take profit objective. Also, you know, as I briefly touched on at the start of this webinar, you can also use resistance levels to converge with the take profit. Now, if a resistance level comes in a little earlier here, and I'm talking about a notable resistance here, it might be an idea to consider taking profit early or taking partial profit before reaching the actual take profit objective, because they can, as I'm sure we all know here, they can react to resistance levels before hitting the take profit objective, and even force a retest of the pattern here before even reaching the take profit objective. This is just something to bear in mind, guys. Okay, so on to the next slide. We have a pound-dollar 30-minute chart showing a. This is, you know, this is just my opinion, guys. Again, this is what I would call a clear-cut bullish pattern, bullish pennant pattern. Excuse me. So we can see the sharp up move here. Now, you remember when I said the sharp up move, they've got an incredibly high success rate. And the 2-point tests of both trend lines. So as we can see here, 2 points there, 2 points there, to validate the pattern. You'll also note the pattern on this occasion easily extended its take profit objective and broke these highs here. So also there's something I believe if you use volume as well, which I don't, especially not in the retail FX market, you want to see a volume increase as we form the first leg, and decrease within the pattern, and then increase on the breakout. Okay, so just moving quickly on to candlestick patterns. As I said at the beginning of the webinar, I believe this was made famous by a gentleman called Steve Neeson. Guys, his book really is, if you're interested in candlestick patterns, his book really is a worthwhile read. It's got every single candlestick pattern you can trade there. In the FX market, I've really noted only a few are applicable. I've found that are worth my time looking for them on the chart. So for the purpose of this presentation, we'll focus on two individual candle patterns called the hammer pattern and shooting star pattern. Now, do bear in mind that these are sometimes referred to as bullish or bearish pin bars, or I believe Pinocchio bars, but I think this was originally coined by Martin Pring. This is another guy you should look up if you're interested in candlestick analysis. So hammer candles are generally found at market troughs or lows, and are considered bullish signals. Therefore, we must ensure that they're formed following a down move or a downtrend. The pattern structure, the actual candlestick structure, should I say, is comprised of a small real body at the upper range of the candle, with little to no upper shadow. This is the best that I've found, and a lower shadow which is at least twice the size of the candle's real body. So I know many traders have different opinions on this, but for me the candle body is irrelevant. It just depends on the location where the candle's formed, for me anyway. Okay, so for the shooting star candle configuration, it's simply the mirror opposite of the hammer pattern, and is considered a bearish pattern. So we want to see these formations form on pullbacks within a downtrend. Again, the candle body, for me anyway, is not a concern. But what we do want to see is the upper candle's body. Is the candle's body close near the lower side of the candle range, with little to no lower shadow. And the upper shadow must be at least twice the size of the candle body. The psychology behind these candles, you probably can go quite in depth, but but for me, it's quite. I try to keep it as simple as possible. So a hammer candlestick indicates a complete, rejection of bears by the bulls. The long lower shadow to the downside shows us that bears were able to push price downward before bullish momentum emphatically pushes price back up to the candlestick's opening price or high price. And guys, it's essentially the same for a shooting star, but around the other way. So it's exactly a mirror opposite. Also, keep in mind that these patterns are found, they're found off trendline supports and support and resistance levels, and are often used as confirmation triggers. So what I mean by this is we can never know if a support and resistance level will hold, no matter how much confidence we have in that level. Though by waiting for additional candlestick confirmation, this may help elbow the odds in our favor a little more. So what it also does is provide a structure for entry and stop loss placement. So entry is normally, let me just show this. Entry is normally on the break of the hammer candle's high, if there is a high. If not, it's the upper range of the candle's body, with stops placed under the lower shadow of the pattern. Now, I've seen many people say just 2 pips beyond the lower shadow is adequate enough. But if for instance we have notable support or resistance, support down this way, I would always look to place my stops beyond that support instead of relying just on the pattern. So just for example, if this pattern forms off support, but we have another support down here, this could be, I'm going off a little bit here on a dive. So so what I'm trying to say is if we have support here and the pattern's reacted off this support, if there's a support down here, I would always look to place my stop loss conservatively. That's what I'm trying to get across here. I would never look just at this pattern and a support as an entry trigger. So obviously for the shooting star, a bearish signal. So obviously for the shooting star being a bearish signal, traders execute sell orders on the break of the candle's low, or the candle's body, or the candle's lower range of the body, and place stops above the upper shadow. Will this webinar be uploaded? Sorry guys, I'm just reading the question. Will this webinar be uploaded on YouTube? Yes, it will. It'll also be uploaded on the FP Markets website, FPM's YouTube channel, and I believe following this presentation, support will send out an email regarding the recordings. So guys, look, I've got through I purposely left some time here for some questions about this, because I understand, at least for newer traders, it's good to talk about this, especially the patterns we spoke about, and any candlesticks. So guys, if you have any questions, please do feel free to ask them now. I'm more than happy to go through any questions you have. If you could just fire them in the questions box if there are any. If not, we can have a look at some charts, or say just let me know any charts you fancy looking at. Wow, I must have done a good job. Zip. Z1P. I'm not sure. Okay, the hammer candle represents bullish market. So the hammer candle represents a bullish market. No, so the hammer candle it always needs to form in a downtrend. Or on a retracement within a trend. So so no, it's not formed in a bullish market. It's formed within an so let me just I'm just trying to think of the best way to explain this so I don't confuse anyone. So a hammer candle will always form after a retracement or within a downtrend. As I said in the presentation, it can form at support. Yeah, it can form a support. It can form at a number of different support structures, like the trend line support. But yeah, ultimately the hammer candle will form on a bearish retracement. So that could be an uptrend followed by a retracement, and into support or something like that. Can you please repeat where you said about stop loss and support and resistance? Yeah, okay. I assume you're talking about the candle patterns, Lee? Yeah, okay, excellent. So for stop loss, this is just traditional, a traditional, you know, a presentation of entry and stop. There are other ways that traders use these. So, for instance, for the hammer candle, a lot of traders they set a buy stop here, which is a market order once it's tripped, and they place their stops 2 pips below the lower shadow. However, as I said in the presentation, if this forms off a support level, and you're a conservative trader, you can always get whipsaws in this in any market. So I would always look at the surroundings of the chart. So if there's another support here, which has a good history further back, further back, I would always look to place my stop below that support to give me a little bit of breathing space. Also, there's another. I've seen some traders, they like to enter here on the halfway through the candle, so they're expecting a pullback. So you will see this happen a lot. Price will come up, it won't touch your stop there, it'll come down, and it'll just give you a better entry, really. It's better risk to reward. It's the same for a shooting star as well. Yeah, I hope that helps, Lee. Does the candlestick formation follow in the chart pattern as well? Kevin, I'm not sure what you mean. Does the candlestick formation follow in the chart pattern? So if I understand correctly, do you mean can you combine the two? So with the candlestick, with the candlestick formations and the chart patterns? If so, yes. Oh yeah, you can. 100% you can. So for instance, let me just go back to the slides. Oh, wrong slide. Let me just go back to this quickly. So yeah, so at times I've seen as well. I did a small test on this as well. So with bullish flags in particular. So for instance, we have the sharp up move, we have the channel slope, and then we have the breakout. But what you'll see is price often retraces and retests this limit. But what you look for on the retest is a candlestick formation on this retest. Now, excuse me, if you see this on the H4 time frame, for example, it's a swing trading time frame. So if you see that breakout form, what you can do is drill down to the lower time frames and see if price retests that base and forms some sort of entry trigger in the form of candlestick configurations. This is what I would be looking for, especially here around this area. So imagine we break out and we come down and we retest this limit here, and we form a candlestick formation. However, with these patterns, you have the choice then. You have the choice of either using the candlestick configuration as an entry trigger and placing the stop below that candlestick formation, or using the patterns structure to place your stops below here. That's something I should have mentioned, actually. I just didn't want to go into too much detail to confuse newer traders. But with these patterns, so entry would be considered here, for me anyway, would be considered here. And I would always place the stop below the pattern's lower structure. Same here, below the lower structure. I hope that answered your question, guys. Okay. Yep. It's kind of following the chart pattern. So that's for Kevin. I hope that answers your question, Kevin. How can we find out when the resistance, Tristan, I'm not how can we find out when there is, I assume you mean how can we locate resistance? If so, there are a number of ways, as I said in the presentation, there are a number of ways that you can excuse me, that you can locate resistance or support. The most common way is to look for the highs and lows and join them up. There's also, you can also use the candle bodies. Look, if I just go to a chart, let me see if I can find it on a chart. Just real quick. Here we go. So for instance, people look for, a lot of traders actually look for the highs, joining the highs up. But this can be very difficult in my opinion, very, very difficult. So what I tend to do is, among other things, is look for the candle bodies. So I look for a a joining of the candle bodies here. So it's clear we have resistance here, right? We have resistance. Now, nothing in any market is going to be perfect. It's impossible. I'm sorry, but not every time anyway. But if you want a resistance, so we have a resistance zone. So always consider them zones. You don't look for definite price points in the market. So for instance, I would call this a clear resistance because look, we formed a resistance point here. Price, yeah, we did fake out higher, but we did drop considerably, right? And we broke these lows, and we made a considerable low, in my opinion. So when we come back up, yeah, we had another whipsaw, but price did react. Same here, guys. Look, we have support here, support here. There are a number of, as I said, there are a number of ways we can highlight support and resistance. It's just beyond the scope of this webinar to go into it. We do have a webinar coming up, I believe, with just dedicated to support and resistance. I think I'm doing that as well. So what I'll do is I'll go into detail about the number of different resistances you can use. One other thing I will say is support. So resistance. So another example here, we have resistance here. So once we break that resistance, it normally forms support. So as you can see, we had resistance here and we had a nice move down. We come back up, we break that support, and then we react. We break that resistance here, and then we come back and we react as support. This is a common view across all markets. Are there candle patterns that are more relevant to day traders? Good question, Luke. You know, in my opinion, I would always go for the hammer and shooting star and the bullish and bearish engulfing patterns. But traditional interpretation of a bullish and bearish engulfing pattern is very seldom found in the FX market because of the way price opens and closes at the same points, right? In the stock market, it's very different. We form genuine bullish and bearish engulfing patterns. What you'll find in the FX market is you'll see bullish and bearish outside reversals. It's the same thing. It's just terminology. But yeah, they're the two patterns I would always focus on. But again, these are only confirmation triggers. These candle patterns, in my opinion, I would never ever trade. You know, I would never trade solely on candlestick patterns. They always have to format something. You know, something I would say something considerable into support or resistance, or a notable trend line support or resistance. In terms of being okay, that's good, Lee. Okay, I'm not sure if I missed it already as I came a bit late. Where do I place the take profit? I assume you're talking about the patterns. So I think you might have caught that one. I just explain it there. Just let me go over it real quick. So take profit objective for these patterns are simply taking the distance of the up move, and then simply adding this to the breakout point. But as I said, always take into consideration your overall surroundings on the chart. You know, if a large resistance here, let's just keep it simple. If a round number is here, a large round number. I know we are on the pound recently. I think it's pound. Yeah, on the pound, we recently broke the 120 level. No, sorry, the euro dollar 120 level. So for instance, if the 120 level is here, but your take profit objective is there, it's highly likely you're going to get a reaction from this 120 level. So just factor that into your trade management. Never rely on these solely. Always look for your surroundings. Always take into consideration higher time frame areas. So what I mean by that is, if this is on the excuse me, if this is on the H1 or H4 time frame, if you have a weekly level here, what's the chance? There's a good chance it's going to react, a hell of a good chance. And if you're waiting for another 10 pips to reach your take profit objective, it just doesn't make any sense. The least you could do is reduce your risk to break even, right? And protect yourself, and maybe even trail behind any swings that formed here. That's just my opinion, guys. That's how I would handle it. What's the difference between a hammer candle and a hanging man? Yeah, George. So a hanging man is, let me just get back onto the chart. So a hanging man is simply a hammer that's formed within an uptrend. Yeah, and these are bearish signals, but so for instance, imagine we're rallying, and we form a hammer here. That's a hanging man with excuse me, with the same configuration. So the small body, twice the size, and little upper range. But for me, I'd always wait for price to actually close below the lower shadow in that case. That's my confirmation trigger. So the hanging man would be here. We would wait for a bearish close to form below the low of that lower shadow. I hope that answers your question, George. On the hammer pattern, do you place any significance on the close of the second green being above the open price and the lead? Yeah, Nick, you can do that, and a lot of people do that. So what I mean, if I understand you correctly, you're looking at this as a confirmation trigger. Yes, they do. A lot of people do, but then you're sacrificing some risk, some reward, right? So if you enter, say here, where's your stop going to be? It's going to be right down here. So you need to ensure that your risk reward is in check. So for instance, if your target is up, it's just here, and your entry and stop is there, this distance, you've not got a very good trade on your hands. So it's all about the structure of the market. If you have room, yes, I would definitely take that as a confirmation trigger. Also look for a strong candle. Ideally, you don't really want to see excuse me, you don't really want to see a candle that is traded considerably off best levels. You know what I mean is, so a candle that's imagine this candle here being this candle here. So we have some strong selling coming. That's not a good sign for a bullish signal that's just formed. So that's what I would always look for anyway. But again, just take into consideration that you need to account for your take profit target, which, as I said, if it's just up here, it's probably not a trade. It's probably a trade worth passing unless you're confident it's going to go beyond that. Okay, is it better to use higher time frames, for instance H4, to find resistance or support, or does it matter what time frame one's used? You know, I've seen many traders stick to one time frame and do incredibly well. I personally, if you look at the analysis on FP markets, I use a multi-time frame analysis from the monthly, daily, H4, and H1, and it produces. So for me, I will always say use a multi-time frame approach, so you know where you are on the bigger picture. Because the worst thing is you trade. So a very basic setup. You break some resistance, and you think, excellent, we got a breakout trade, right? But if you're trading into daily support, a daily resistance, and from the H1, you could have a lot of problems on your hand. Even if we retest that H1 level as support, right? That could prove a nasty trade. Yeah, so I would always consider the higher time frames. So a multi-time frame approach. So never focus on one time frame. Always look what your surroundings are. I mean, guys, look, trading is not easy, especially from a technical standpoint, even a fundamental standpoint. It's not an easy game. It takes a lot of screen hours to work out your rhythm, should I say. So yeah, you need to take in every single aspect of the chart to understand where you are. This is just my opinion, guys. This is how I analyze the charts. The context of hammers provides the insight of if a low or high lies ahead. Context of hammers provide the insight of a low or high. I'm not sure what you mean there, Ivan. If you could maybe explain a little bit more, that would be great. So Luke, H4 and H1, what does this mean in terms of time frame? So the H4, so imagine this is it's a 4-hour chart. So every candle that forms, so a candle is formed every 4 hours, and for the H1, every candle is formed each hour. So there'll be 24 candles on the H1 and per day, and for the H4, if my math is correct, I think it's six candles, 4, 8, 12, 16. Yeah, six candles per day. So it's just you're taking a closer view. So if you go to the H1 time frame, you've got more detail. You've got more detail to deal with in terms of price action. Can you please mention those time frames once more? Luke, did I answer that question now? I hope I did. With regards to time frame. So look, on the daily time frame. So on the daily time frame, that'll be just one candle per day, right? That will encompass all the day's trading in one candle. So we'll have a open, close. So look, I'll do it on here. So for instance, we have a daily time. Imagine this is a daily time frame. So one candle per day, one candle per day, one candle. So if this was a H1 time frame, this will be one candle per hour. Each hour a candle is formed. Okay, so next one, what time frame should one use when analyzing support? So George, look, I believe I went over that already. So ultimately it's up to you as a trader. But for me, I love a top-down approach. I absolutely love the top-down approach because I like to know where I am in the overall scheme of things. You know, if we're coming off a monthly support, I mean, guys, just do yourself a huge favor. Look at 4 time frames. Try this: monthly, daily, H4 and H1. Just look at them. Look on the monthly time frame. Where are we coming from? Are we bouncing from support? So if we're bouncing from support, we know highly likely that we're going to break any daily resistance that's close by. So we have. Let me just show you. Actually, let me just show you. I've got a perfect example on the euro that I recently analyzed. Let me just spin the screen over just real quick. So guys, I hope you can all see this screen. So this is the recent analysis I did for FP markets. So look, here we have the monthly time frame, right? I'm going into a bit of detail here, so please do forgive me, any newer traders, if I confuse. So look, on the monthly time frame, we have what we went over, a bullish hammer pattern, right? But it's not yet closed. So at the end of this month, we'll know if it turns into a genuine. But at this genuine hammer pattern, but at this time, it's forming a hammer pattern. So we know we have room to reach this ascending resistance here. So with that being said, we know that there's room to rally, right? So with that in mind, we know, I said this in the analysis, we know that the indecision here was likely because we have room to move on the monthly time frame, and you know, to break these tops, it was highly likely. I said this recently. I think it was in today's analysis, excuse me, that we're likely to break these 2190 tops and reach for this Quasimodo resistance. Now, I haven't gone over Quasimodo resistance, but guys, I do plan to go over that in future webinars. If you want to check that out before I do, please go ahead, because it is an absolute awesome way of defining Quasimodo resistance and support in the markets. So as I said, look, we have room to rally on a monthly time frame, and we recently broke a large resistance area here. So knowing that, we know that 2190 tops on a daily time frame are likely fragile. So with that in mind, I also said we're unlikely to get much of a reaction from these Quasimodo resistances or these levels here. So knowing by the monthly time frame, we have room to rally, right? And we've broken, and now we've broken, and because of that, I knew that there was a good chance we were going to break the 2190 tops, and it's unlikely that we were going to see much of a reaction from these resistances or these resistances. So with that, we know we have a bullish vibe going into our analysis. So we could so from going forward, we could look for a 122 retest here, right? But here's a perfect example. We could look for a 122 retest, but we now have to deal with 122.14 resistance on the H4. So you have to be careful still. So here, if we retest this 122 level and form a candlestick formation, so a bullish hammer pattern, for example, we potentially have quite a good trade on our hands. So again, we form a bullish candlestick formation here, and we could look to place our stops below, maybe here. I'm not sure. I've not really looked into this yet. This is for later on. So I hope that helps, Luke. Yeah, okay. So what time frame should one use when that? Okay. Okay, it seems like all the questions have been covered. If there are any more, please do fire them across, and I will try to get through them as quickly as I can. Guys, I do hope this helped. This this helped. It was only a quick run through, and if you would like to see more of that, more of this kind of analysis and the way I look at charts and the way I use multi-time frames to pinpoint my direction and understand where I am located in the markets, please, as I said, feel free to send any suggestions over to the FP Markets, the market analyst email that I highlighted at the beginning of the webinar. So look, I think with the Q&A done, okay. Oh, it's a pleasure, Sandra. No problem. Oh, good. Thanks, guys. Okay, so thanks for putting this webinar. Much brilliant. Thank you, guys. Look, I really hope. Yeah, I think this is all we got time for today. But guys, look, I sincerely hope some of our newer traders were able to walk away from this presentation more knowledgeable. As always, guys, please, if there are any specific topics you would like to learn here or talk about, please be sure to send in your suggestions, to marketanalyst@fpmarkets.com. Yeah, so look, guys, fantastic. I hope you all got something from it. That's really good. Thanks for the kind words, guys. It's excellent. So yeah, okay, on that note, thank you all so much for taking the time out of your day to attend the presentation. I hope I haven't confused newer traders too much, and yeah, please keep going. It's a fantastic way of making money once you've attained some proficiency. I'm absolutely addicted to trading. Not addicted, obsessed, I would say. Obsessed with chart action and the chart psychology behind it. So yeah, please feel free, as I said, shoot over any questions or any suggestions for future webinars to marketanalyst@fpmarkets.com. So okay, on that note, guys, thank you so much for taking the time out of your day to be with us. 1 second, there's one more question. Will there be a part two? Look, there's going to be, we've got loads and loads and loads of webinars coming up. I'm going to really deep dive into price action, really deep dive into price action from beginner to intermediate to advanced. But guys, if you enjoyed this kind of thing where I looked at the charts and I went through some analysis with you, I actually enjoyed that because it was more of a freestyle for me, and it's what I do every day. So please look, let me know in the emails or anything in the email I put across, and I'll happily go over that in the next webinar as well. We could do that every webinar as a quick session. So, okay, I really hope you all took something from it. Have a great day, and I'll see you all again real soon. Thank you very much.